Everything feels fine. Markets are open. Spending continues. News cycles move on as usual. There is no panic, no emergency announcements, no visible crisis. And yet something unusual is happening beneath the surface. The largest pools of capital in the world are quietly changing direction, not rushing, not reacting, not explaining. History tells us this matters, because the most dangerous moments in financial systems are not loud, they are calm. So here's the mystery we are exploring today. Why is big money moving while everyone else feels safe? And what do they see that the rest of the world has not noticed yet? To answer that, we need to go backward before we can understand what is unfolding now.
Setting the stage.
How modern money really moves. Most people believe markets are driven by headlines, inflation reports, interest rate decisions, political events. But those are signals for the public, not for institutions. Big money does not wait for news. It watches systems, bank liquidity, debt maturity schedules, credit spreads, currency flows, interbank trust. These are not things discussed on evening news. They are slow indicators that shift quietly. This behavior did not appear recently. It was learned over decades through failure, survival, and repetition. To understand the present calm, we need to understand how power learned to move silently. Origins: when early insiders learned the value of quiet in the early days of global finance, information was scarce. Bankers knew when reserves were tightening before depositors did. Industrial leaders knew when supply chains were stressed before prices rose. Governments knew when budgets were failing before taxes increased. Those closest to the system always had an advantage. Over time, this advantage created a rule that still governs markets today. Public confidence peaks near inflection points. Private caution begins long before fear appears. Big money learned not to predict exact collapses. Instead, it learned to ask a simpler question. What happens if the system stops behaving as expected when that question could not be confidently answered? Money moved. Slowly, carefully, quietly. The rise: how financial systems became fragile while appearing strong as markets expanded globally. Complexity increased. Financial instruments multiplied. Leverage became normalized. Debt became a tool for growth instead of a warning sign. At the same time, institutions grew larger than nations: pension funds, insurance giants, central banks, sovereign wealth funds. These entities could not simply exit markets overnight. Their movements had to be gradual. So a new behavior emerged: rotation. Capital moved from risk to safety without announcing fear. From long-term exposure to short-term flexibility, from optimism to optionality, markets stayed calm because selling pressure was distributed over time. This is why surface-level stability can coexist with deep internal change. And this is exactly what has been happening again. The breaking point: why calm can be the most dangerous signal. Every major financial shift has a moment when the system becomes sensitive. Not broken, not collapsed, just fragile. During these periods, confidence remains high. Participation increases. Warnings are dismissed as pessimism. Meanwhile, big money stops asking when growth will continue. It starts asking what happens if it does not. This is where calm becomes dangerous, because when risk is mispriced, reactions accelerate once reality intrudes. Small disruptions trigger outsized responses. Liquidity disappears. Credit tightens. Volatility explodes. Not because panic suddenly appeared, but because preparation was already finished. Fallout: what happens after the quiet shift? When the shift is complete, the narrative changes quickly. Suddenly there is a reason, a shock, a failure, a policy mistake, a surprise number. The public experiences this as sudden chaos. But from the perspective of big money, it was the final step in a long process. The fallout is not just financial, it is psychological. Trust erodes, certainty vanishes. The sense of safety disappears. Opportunities that once felt obvious become unavailable. Those who waited for confirmation realize confirmation comes last. Failed fixes: why the same solutions keep repeating after every disruption. Authorities respond. More liquidity, lower rates, new guarantees, stronger assurances. And temporarily, calm returns. But the structure does not change. Debt continues to grow faster than productivity. Complexity increases. Risk concentrates. Each fix delays consequences but increases scale. Big money understands this pattern. That is why it moves before fixes are announced, not after they fail. Modern parallels why this moment feels familiar. Look at the present environment. Debt levels are historically high relative to economic output. Asset prices remain elevated despite slowing growth signals. Liquidity conditions fluctuate quietly beneath stable headlines. At the same time, capital is moving. Into cash equivalents, into short-duration instruments, into assets that prioritize resilience over expansion. This is not fear, it is preparation. We've seen this movie before. Periods of calm that precede adjustment. Confidence that masks structural strain. Silence that hides motion. The pattern repeats because human behavior repeats. 3 clear takeaways. What this means for you. Takeaway 1. Calm markets do not equal low risk. They often mean risk is hidden, not absent. Takeaway 2. Big money moves based on system behavior, not headlines. By the time explanations reach the public, positioning is already complete. Takeaway 3. The most important question is not what will happen next. It is whether you are prepared for multiple outcomes. Final warning, the question that remains, history never announces turning points. It only reveals them after they pass. The real danger is not volatility. It is false stability. When everyone feels comfortable, preparation feels unnecessary. But comfort is not protection. The question is not whether change will come. The question is who will be ready when it does. Call to action. Stay ahead of the story if you want deeper breakdowns of the shifts most people miss. If you want to understand systems instead of chasing headlines, if you want to think ahead instead of reacting late, subscribe to the channel, because the most important moves are rarely obvious, and by the time they are, it is already too late.